I'm leaving early.
Oh, yeah, okay. So what time you got to leave?
My plane leaves at 3.
Oh, okay, yeah. You won't be here for that, so it'll be you and I, Gareth, and Rob. Okay, 5, 4, 3, 2, 1. Okay, welcome back after our break, everybody. We're back, just finishing off so the final presentation with David here, and then we're going to go to straight on to our next presentation, which I believe is with Gary Dayton or Gary Fullett. I'll have to check that one. Anyway, here's back to David to talk about this chart. Here we go.
We finished this chart.
Okay, I'll move the next one.
All right. Well, we finished this chart. Looking at it, we discussed how the net volume was giving you some good clues, and we had a spring and so forth. Let's go on.
Okay.
All right, this is an important chart. This is the S&P E-mini daily chart. Here I have, of course, this time I don't have tick volume as a line, but I have contract volume on top of the true range. And below that I have the net difference between the up and down volume. And this was pretty much a classic top in that you see that narrow range day, April the 26th, where the market made a slight new high and closed near the low. That was quite an indication that the market was going to go lower. Of course, how much lower and how it was all going to unfold was a different matter. Another important thing on this chart, well, this chart doesn't have the whole, this chart was probably plotted through Tuesday or something like that, so I don't have all the history. This doesn't have the big break on it, does it?
No, on that one.
That's strange. Well, in any event, you see the huge ranges, the big red range bars, showing all the ease of movement on the downside. And you see, along with that, we have volume spikes at the same time. And also, we have large net down volume. So it's pretty obvious that we've had a great deal of selling here. I like to call this distribution. This doesn't look like the classic pattern of distribution as defined by the Stock Market Institute, but with all of that selling and all of that ease of movement, heavy volume, I think it's quite clear that somebody has been distributing stock in a big way. Tom Williams says he thinks that this break that we had on May the 6th was a washout. And he uses as evidence the position of the close being well off the low. That's certainly possible. And now the market has rallied back to a very obvious resistance point and turned down again on Friday. So this pullback, maybe developing from last week's high, is going to be important to watch to see if indeed the market is going to hold. I would not expect to see a break below the low of May 6th anytime soon. This is just an opinion, though. I'm looking more for a trading range to develop, and it could last several weeks or even months. And in the process, we might even go a little higher than where we were last week.
Why, David, do you say a trading range rather than, say, going down at this point, or going up for that matter?
Well, the question is, why do I expect a trading range? I just don't think things are going to happen that fast. But as I said, this is an opinion. And obviously, I'm going to be judging the market every day. I write about it every day. I send a report out to friends and clients every day on the S&P. Would it be bad to say if anybody wants a copy?
No, please do. I encourage it, by the way. This is the reason you're here.
I'm willing. Anyone who wants to give me their email address, I'll send it to you for a few days, and you can see it. There's no charge for it whatsoever, but it's mostly going to my clients. And
can I have a copy?
No.
What about next week?
I said that if you're interested, I'll send you my report that I write every afternoon or every evening on the S&P.
It'd be very interesting to see Tom's newsletter at the end of the week and what your reporter said. I think
Yeah.
that's powerful stuff. Yeah.
Yeah, it's powerful. Yeah.
So you were long, S&P early March, early April, and you saw that the narrow range bar that made it new highs. Would you use that as a sell signal?
Absolutely.
You want to repeat the question then?
No, I'm sorry.
Yeah,
The
go
question was, would I use that narrow range bar on April the 26th as a sell signal? And I said absolutely. I went short on that day. And I have the report that I wrote the afternoon of the 26th. It's the next chart or so, where I said I thought it was going down. I don't remember exactly what I said on there, but the text is there.
Initial target?
Did I have an initial target? I don't think I mentioned one. It's in the text. It's in the book there. But I guess I've been looking for a pullback to the February low. That's what I've been expecting. And I think I mentioned that we could go to the February low. I don't know if it was in the first report or a little later. But I've been saying it for some time. And of course, we did that almost on May the 6th with that wide open break. Pretty much satisfied the first idea where we might go. But again, that was just an opinion. All right. You understand why I say it's just an opinion. Someone chuckled, but I mean, I realize that I don't know. And when I want to impose my will upon the market, that can be very dangerous. I have a friend who's an extremely smart person and a great reader of the fundamentals related to the cattle and hog markets. I asked him why he so favors those two markets, and he said, well, all the statistics are there every day. You get the slaughter, you get the in movement and the out movement from storage, and on. All these figures are there every day on the wire. And it's very easy to build a model of what's going to happen. And so he builds a model, and he's almost always right. But when he's wrong, he doesn't admit he's wrong. And he knows that he's right. And maybe he is, but there's somebody out there who's going to do something anyway. And then he'll say, well, it shouldn't have occurred. Well, I always hear Gilda Radner in the back of my mind saying, never mind.
Can I ask you a question?
Yeah.
The one thing about a newsletter and the one thing about YouTube, which I absolutely love, is you can go back in time to see if what you said about the market actually came true. In my case, my claim to fame was the oil market call, and Tom's newsletter, Gary, you read it, I read it. Each week, if you go back and look at the newsletter and what the market did, I don't think yet he's been incorrect about what he can't predict a black swan event like we saw Thursday, but he said the market was weak at that level and don't go long. I mean, that was pretty clear. When you look at your newsletters and you review them, I mean, do you look and see, have you made any major errors and any major boo-boos, or do you actually look at them and say, they're surprisingly right?
I try not to congratulate myself too much. I found that as soon as I start patting myself on the back, I'm guaranteed to have something horrendous happen. I used to write letters, market letters, for years. What I write now is just a little one-page blob, or whatever you want to call it, on the S&P. It's rarely more than one page, and most of the page is a chart. It's not very wordy. But in the past, I wrote a market letter that dealt with Elliott Wave for Robert Prechter for several years, and I wrote a market letter for a brokerage company for many years, and then I wrote my own market letter, Technical Forces, for a number of years, using primarily Wyckoff, but some Elliott Wave. And I made good calls that were marvelous, and I made some that were horrendous. Mm-hmm. So I've run the gamut of being right and being wrong.
Yep.
Hamlet said, nothing is good or bad, but thinking makes it so. I like that.
Yeah.
All right, well, let's go to the next chart. I think this is the report that I wrote on April 26th. Let's see. Yeah. This is a rave chart. Wyckoff made rave charts. We already have heard, or we will hear from Gary Fullett about rave charts, but he also made rave charts of individual stocks. This is a rave chart of the S&P E-mini. And to make the idea behind a rave chart is, and it's an interesting idea, price movement does not unfold in equal units of time. Price movement unfolds in buying and selling waves. Would you agree with that? Well, they do. They don't know anything about 5 minutes and 10 minutes and 180 minutes and so on. That's what we do. But we can still see the price movement very well. No problem. By dissecting price data into equal periods of time, we still see the sweep of the move. But when you dissect volume into equal periods of time, you do not have an accurate picture of the true force of the buying and the selling. So if you can make a wave chart and show the wave volume, the volume per wave, then that might give you some other insights. I'm always looking for a better way to see volume. I showed you this chart of the net difference between up and down volume and the cumulative line. Always looking to see if there's a better way to read the volume than just what we have per bar. Although I'm very satisfied with it, it's just something to do with my mind, I guess, while I watch markets all day. But I used to keep wave charts by hand for many years. And those were the days when we didn't have actual volume on an intraday chart. We had tick volume. And I kept these charts, I still have them. 1982 low in bonds at whatever it was, $61 or whatever. But this chart, it goes back several days, I guess you can see. Can you read what I wrote there? Are you able to read that?
Yeah, I can try.
You want to read that?
Yeah, and let's give me the headset and I'll take that.
Okay.
As an experiment, I'm beginning to take a look at the action of the E-mini S&P on a nightly basis. I can guarantee this will appear every night.
There's a correction. It will not appear every night.
This will appear every night, not every night, and it will continue very long. Got it. Tonight I'm showing the half-point wave chart constructed from day session only 30-minute closes. There are two interesting features. First, the last up wave to a new high was made this morning, and it had the smallest volume for any up wave lasting more than 30 minutes. The afternoon down wave lasted longer, 120 minutes, than any down wave since the April the 19th low. In his tape reading course, Wyckoff said a minor trend change occurs when buying begins to diminish in size and duration, plus the selling waves begin to increase in size and duration. Couple these tape reading observations with the narrowing of today's price range on the daily chart as price made a new high, and we have the ingredients of an upthrust. If so, there must be downward follow-through tomorrow. And then the corrections right at the bottom, which I couldn't read at the time.
Yeah.
There you go.
Well, anyway, so what I'm saying here, excuse me, what I'm trying to say here, my glasses are gone.
There you go.
All right. Anyway, to make a wave chart, Wyckoff, of course, was watching the tape. And his tape was much slower than what we have today, watching the market unfold. So he would have a wave chart made from, say, on U.S. Steel, and he would monitor every tick and construct his chart. Say if he's going to do an eighth of a point reversal, then as long as the market traded at 69 and an eighth, he stayed there and added up the volume. And then when it traded at 69, he increased the size of the wave on his chart and added more volume until it reversed up a tick. Well, we can't do that on a tick-by-tick basis in stocks or in the S&P Mini. They would be the size of a football field for every day. So what we have to do is come up with filters. So the first filter is, I'm going to use 30-minute prices. And the second filter is, I'm only going to use the 30-minute closings. So in a day of 24 hours, you have 48 closes, right?
Yeah.
There are 48 pieces of data per day that I'm going to survey to make this chart. This is obviously not designed for day trading. I do make some wave charts using 1-minute closes. And of course, I wouldn't do that in the S&P because it's just too active. But I've done it in other markets. And it's uncanny. You have a question?
Yeah. I understand that you use the tick volume.
This is real volume.
Okay. But I understand that on prior charts you've looked at tick volume
Yes.
and real volume or contract volume. Do you ever look at the relationship between those two volumes?
The-
Indicate, for example, that ticks are now consisting of larger numbers of contracts.
The question is, do I ever look at the difference between tick volume and actual volume? The relationship, rather, not the difference, but the relationship between the two. I must say I haven't, but it sounds like an interesting idea, at least intellectually. I don't know about practicality, but it's something I've never done. I would think that since tick volume is activity, tick volume is telling us how many times a market changes price in a given time period. And Wyckoff did study tick volume, activity with his charts. But the way he determined activity was rather archaic. He measured with a ruler how many feet per minute the ticker tape moved. And that was activity. And he made a chart from those readings during the day. And he plotted those against the volume. Well, you know, today that would again be very impractical.
Can I just say a quick word? Paul, just so you know, Tom Williams does exactly that. He uses tick volume. Now, Tom's probably itching right now. He's listening to get in and say something here because he developed a product with another programmer, a Polish programmer, which we can't release to the public, but I'll talk to you about it. And the reason is that product cannot be supported because it's an old version. We're trying to emulate it at the moment. But what it does, as I was mentioning earlier, in similar terms with eSignal, their volume is activity volume in the Forex market. That's exactly what it is. I'm going to show people, before I go tonight, make sure you remind me, how if you look at the currency futures, which is an exchange-traded contract, and align it with the activity on the spot, it'll give you a very serious edge. And I've not shown that publicly, for this will be the first time I've done it, and we're testing something with it. But if you just put 3 time frames on one side on the spot and 3 on the currency futures, you'll be quite amazed how the spot begins to move quickly with the activity, and the currency futures will have to follow. And you'll get some very serious... Mike, we discussed this, I think, briefly at lunch, and we'll try and show you something that you can follow through on.
All right. So you notice, as I said in the little comment, this is the whole size of my report that I write every afternoon. I don't show this wave chart. The first time I've shown it in months. Well, I just started writing these little reports on this day. I hadn't done it in a while. But it's very hard to get the volume. That's the hard part. It's very easy to make a wave chart. Anybody can do it if you have the zigzag function as an indicator on your software. You know what I'm talking about? There is an indicator called zigzag, and you just tell it what size reversal. It's just like a point and figure. This could be a point and figure. Instead of showing lines up and down, you would plot X's and O's, and you could put volume underneath it.
David, would this be like a Cargi chart?
Not at all.
No, it's different.
No,
Yeah, okay.
no.
Okay.
All right, well, let's go on.
Okay.
All right, this is a chart of silver. I trade silver a lot during the day, particularly now that it's moving nicely. this is a 3-minute chart on July silver, and I have the volume, and I have the difference between the up and the down volume, and then on top of the price is that cumulative line of the difference between the up and down volume. And you can see how the market came down. I've drawn a little red arrow up here at the top where we had a rather unobtrusive amount of volume, but still that was a turning point. That's where supply came in, and then it poured in, and we had very shallow corrective rallies and came down to a low with a lot of stopping volume. We had a rally, and then right here you see how the market came back to the low to test, and we have a small penetration of that support line. And when we do, we have relatively low net down volume. It doesn't tell us anything. But when the market turns up on the next bar and starts the spring, look at the size of the net up volume. You see how it surges real big there. In fact, it surges more distinctively than the volume did. The 3-minute volume on that big bar right here, where I have that up arrow, doesn't have outstanding volume, but it has outstanding net up volume. You see? So that's a very good clue that this is for real, that this is indeed demand. And the rally from that low is probably good for about $3,500 a contract that day. I believe this was May the 5th. So this is what I do during the day, is I watch charts like this or the 5-minute chart and try to find the right setup and put on some contracts and see if it'll work. Try to get the edge where the risk is the least at the danger point. Anybody can do this once you learn some of the basics. All right, you want to see the next chart?
Yeah. Richard, do you want to change the tape now? Yeah. Well, we're just changing the tape, so before we start again, we'll just...
There must have been something there. What was it?
No, that's a blank page.
Mm.
That's the next chart.
I don't want to discuss that chart.
No, nothing on there much.
No.
And then...
You can't read that.
Yeah, oh, well, they've all got a copy of it, so everyone's got a copy of that. So, yeah, we call that a wrap, I think.
That's a wrap.
Yeah, so, ladies and gentlemen, please give a very big round of applause to David Weiss. What a great presentation.